finally get the money so they don't owe us anymore, do they? And so our accounts receivable is going down. Now look what's happening here. Our cash goes up, our accounts receivable goes down. Is our equation still in balance? Assets equal liabilities plus owner's equity? It is. One asset went up, one asset went down. It's still in balance. The next one. Purchase supplies on account for $3,100. What happens there? Which two accounts are affected?
AP and supplies.
Supplies are affected, they go up. And accounts payable also goes up, doesn't it? Because they owe us the money, right?
We owe them,
Oh, yeah.
but yeah.
We owe the money.
Yes.
Okay, right. Now, let's go over to the next problem. Now we're going to use this tabular to handle these particular situations. Cash, accounts receivable. Oh, that's what we already did. Okay. Now we're going to use cash, inventory, equipment. So let me just clean this up. And I'm going to make this one inventory. See what I'm changing? Equipment. Oh, God. Clear. Okay, cash, inventory, equipment. What else do we need to show? Accounts payable, common stock, and retained earnings. We've got just one accounts payable. Common stock and retained earnings, okay? So we're going to get rid of this part right now. So let's look here at A. We purchased equipment for $286,176 in cash. What happens to our cash? It goes down. What happens to our equipment? It goes up. So we're going to show cash go down, but equipment goes up. Does our accounting equation still balance? Assets, one went down, one went up. We're still in balance, aren't we? Make sense? Next. Issued common stock to investors for $137,590 cash. What accounts get affected? Cash does what? Increases. What else increases? Common stock increases. We've issued them. So our equity section increases. Next, purchased inventory of $68,480 on account. Did we use cash? No, it's an accounts payable. What happens to our inventory here?
Increasing.
It increases. What happens to our accounts payable?
Increase.
Increases. So we've got an increase in inventory and we have an increase in our accounts payable. We owe the money, don't we? Now for, boy, did I skip ahead. So let's go back to our cheat sheet, okay? let's go back to our little cheat sheet here. Now, remember this cheat sheet? If it's a normal balance, that's the sign where an increase is going to happen. If it's the normal balance is a debit, that means when we increase it, we're going to debit it. If the normal side is a credit, then that means that's the side we're going to use to increase it. So, let's look at this example while we figure out this next problem. Okay? So, for example, accounts payable indicate the effect of a debit or a credit on an accounts payable. Find the accounts payable on this cheat sheet. It's a liability. What do we know about a liability?
Credit balance.
It's a normal credit balance. So when we want to increase a liability, we're going to credit it. When we want to decrease a liability, we're going to debit it. Make sense? What's the next one in the book? Okay, I'll get it. It's okay, I'll get it. Advertising expense. Okay, advertising expense is really part of stockholders' equity. Okay? It's really an income statement item. Revenues increase stockholders' equity. Let's look at that. Stockholders' equity has a normal what? Credit balance. So when revenues come in, then we're going to increase stockholders' equity, which is credit. But expenses take away. So what is a normal expense balance? It's a debit balance. So a debit balance in the expense is going to increase your expense. But ultimately it's going to take away from stockholders' equity, because what's the normal balance of stockholders' equity? Credit. So when we increase our expenses, we're going to debit the expense, but it ultimately reduces stockholders' equity. Does that make sense?
Yeah.
Next, service revenue. What happens when we increase service revenue?
Credit.
We credit it. A credit increases the revenue account. What happens if we debit service revenue?
Decreases.
We're decreasing the revenue account. Okay? Why would that maybe happen?
Adjustments.
Adjustments. Let's say instead of it being revenues, it was a sales of a product.
Right.
So we may have sales that increase it. And then there may be times where, just simplistic purposes, someone brings back an item. Okay, so technically I'm just visualizing why sales would decrease. Okay? Next, accounts receivable. What kind of asset, what kind of account is an accounts receivable?
It's an asset.
It's an asset. What's the normal balance of an asset?
Debit.
So when we debit an accounts receivable, what are we doing to it?
Adding to it.
Adding to it. When we subtract or credit the accounts receivable, what are we doing?
It's decreasing.
We're decreasing it. Next,
Retained earnings.
retained earnings. When we go over here and look at our retained earnings, what's the normal balance of the retained earnings?
Credit.
Credit. So if we want to increase retained earnings, we're going to credit it. If we decrease retained earnings, what are we going to do? Debit it. Do you see why expenses have a normal debit balance? Because they're decreasing retained earnings. See what I'm saying? Next, dividends. What happens to dividends? They're like expenses, aren't they?
So
They
debit
decrease
balance.
retained earnings. Therefore, they're going to have a debit balance. Okay? So, the key here, this is tough. Please hear me. A cheat sheet helps, and we're going to spend a lot of time going through more and more problems. Okay? And this might be a chapter we might continue next week. We'll play it out. Okay? Because this is a tough one. So, let's look at one more problem, and then I'm going to take a 5-minute break. Don't ask me why. Transactions for Grover Company for the month of June are presented below. Identify the accounts to be debited and credited for each transaction. Now, guys, use your cheat sheet, okay? Until it starts clicking, use your cheat sheet. Issues common stock to investors in exchange for cash.
Debit cash,
Why are we going to debit cash?
because we're adding to it and it has a normal debit balance.
Correct. What else are we going to do in this equation, in this transaction?
Credit dividends, or credit common stock. Common stock.
Common stock. We're crediting common stock because our common stock is increasing. And if you look at your cheat sheet, common stock has a normal what kind of balance?
Credit.
Correct.
Credit, which means increase. The normal balance is what increases the account. So you see our assets or our cash gets debited, our common stock gets credited. You see how one balances the other? Assets equal or debits equal credits. Next one. We buy equipment on account for $1,100. We buy equipment on account.
So accounts go up and equipment goes up?
Yes. Accounts payable goes up and equipment goes up. So let's think about it. Equipment, for it to go up, what do? Debit it or credit it?
Debit.
We debit it because it's a normal debit balance. When accounts payable goes up, what are we going to do?
Credit.
Credit it because that's the normal balance.
Right.
If you're not sure, go and look at the cheat sheet. Equipment, asset, normal debit balance. I got it.
Yep.
Liabilities, accounts payable, normal credit balance.
Okay.
Next, pay $740 to the landlord for June rent.
Credit cash.
Yep.
Debit, wait.
Credit cash is right. Our cash is going down. We're using it.
Credit cash,
Should we debit the liabilities?
debit,
Debit, rent expense.
Rent expense.
Yep.
We're going to credit cash, we're going to debit rent expense because the normal balance of all expense accounts are a debit. And if you think about it, in stockholders' equity, if the normal balance is a credit, that makes it go up. What happens when we debit it? Goes down. So that expense account ultimately reduces our stockholders' equity, doesn't it? How many of you guys understand what I'm saying? Okay.
80%.
Bills, Matt Wilfer, $700 for welding work done. Now, it didn't say collected $700 from Matt Welter. It
Debit
said
AR.
bills, Matt Welter. So,
So that's accounts receivable.
accounts receivable
Which is an
goes
asset.
up,
Debit.
So
so
debit.
we'll debit it. For work done, what's our other account?
Revenue.
Revenue.
oh,
Revenues go up. What is the normal balance of a revenue
Credit.
account? It's a credit account. Make sense?
Woohoo!
That makes sense.
Things are starting to gel.